Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that separates good investors from great ones: behavioral finance. Ever wondered why you sold a stock too early out of fear, or held on to a loser way too long, hoping it would bounce back? It's not about your spreadsheet skills or how well you read a company's financial statements. It's about your brain. More specifically, it's about the cognitive biases that silently sabotage your investment decisions. By the end of this video, you'll be able to spot these mental traps and build a more rational, profitable investment strategy. Let's get started. So, what exactly is behavioral finance? It's the study of how psychology impacts investors and financial markets. It shows us that we're not always the rational, logic-driven beings we think we are, especially when our money is on the line. Our emotions, our instincts, and our mental shortcuts, known as heuristics, often take the driver's seat. The first major bias we need to tackle is one you've definitely seen in action: herd mentality. This is our natural tendency to follow what everyone else is doing, assuming the crowd knows best. Think back to the meme stock frenzies. People were piling into certain stocks not because of solid fundamentals, but because they saw a massive online community doing it. The fear of missing out, or FOMO, was palpable. The problem is, the herd is often wrong, and following it can lead you straight off a financial cliff. By the time a stock is all over social media, the smart money has often already made its move and is looking for the exit. Another powerful bias is loss aversion. Studies show that the pain of losing $1 feels roughly twice as strong as the pleasure of gaining $1. This makes us incredibly risk-averse when we should be taking calculated chances, and it causes us to hold on to losing stocks for far too long. We tell ourselves, "I'll sell as soon as it gets back to what I paid for it." This is called anchoring on our purchase price, but the market doesn't care what you paid. A bad investment is a bad investment, whether you're down 10% or 50%. Clinging to a loser because you can't stomach the loss just ties up your capital, preventing you from putting it into a more promising opportunity. It's an emotional decision, not a logical one. Then there's confirmation bias. This is our tendency to seek out and interpret information that confirms our existing beliefs while ignoring anything that contradicts them. Let's say you're bullish on a certain tech company. You'll likely spend your time reading positive news articles about it, watching interviews with its CEO, and engaging with other investors who share your optimism. You might subconsciously dismiss or downplay negative reports or warnings about its valuation. This creates an echo chamber that reinforces your initial decision, making it very difficult to objectively reevaluate your position when new information emerges. You end up convinced you're right, even when the facts on the ground are changing. Overconfidence is another classic trap. After a few successful trades, it's easy to start feeling like an investment genius. You might start taking bigger risks, doing less research, and believing you can time the market perfectly. This is when investors are most vulnerable. The market has a way of humbling even the most experienced professionals. A string of wins might be due to skill, but it can also be due to luck, or just being in a bull market where everything is going up. True investing skill isn't about never making mistakes. It's about having a repeatable process and maintaining humility, knowing that you can't predict the future. So, how do we fight back against our own minds? The first and most crucial step is awareness. Just by understanding these biases, you're already ahead of the game. When you feel a strong emotion about a stock, whether it's fear, greed, or excitement, pause and ask yourself why. Is this feeling based on a rational analysis of the facts, or is a bias at play? A great strategy is to create a pre-investment checklist. Before you buy or sell any stock, you must be able to answer a series of questions you set for yourself in a calm state. For example, what is my investment thesis? What is my target price to sell, both for a profit and to cut my losses? What new information would cause me to change my mind? This forces you to move from an emotional, reactive mode to a logical, proactive one. Another powerful technique is to automate your decisions. Set stop-loss orders to automatically sell a stock if it falls to a certain price. This takes the agonizing decision of when to sell a loser out of your hands and protects you from the pain of loss aversion. Similarly, you can set take-profit orders to lock in gains when a stock hits your target. This helps counter the greed that might tempt you to hold on for just a little bit more, only to watch the stock fall back down. Automating your exit strategy is a powerful way to enforce discipline. Diversification is also a fantastic behavioral tool, not just a financial one. When your entire net worth is tied up in one or two stocks, every little price swing will feel like a life or death event. Your emotions will be on a roller coaster, making you prone to panic selling or euphoric buying. But if you're properly diversified across different assets and industries, the poor performance of one single investment won't devastate your portfolio. This emotional buffer allows you to think more clearly and stick to your long-term strategy without being swayed by short-term noise. Finally, keep an investment journal. Write down why you bought a stock, what your expectations were, and what the outcome was. Be honest about your successes and your failures. When you review this journal, you'll start to see patterns in your own behavior. You might notice that you tend to buy into hype, or that you consistently sell your winners too early. This self-reflection is incredibly valuable. It turns every decision, good or bad, into a learning opportunity, helping you refine your process and become a more self-aware and ultimately more successful investor over time. It's your personal data for improving your decision-making engine. So, let's wrap this up. Your biggest enemy in the stock market isn't a bear market or a bad earnings report. It's often the person you see in the mirror. Our brains are hardwired with emotional responses and mental shortcuts that, while useful in other parts of life, can be disastrous for our portfolios. Herd mentality, loss aversion, confirmation bias, and overconfidence are just a few of the traps waiting to derail your financial goals. But by recognizing these biases, creating a disciplined process with checklists, automating your decisions, and constantly learning from your own actions through journaling, you can build a strong defense. You can shift from being an emotional reactor to a rational strategist. Investing is a long-term game, and the key to winning is playing it with your head, not just your gut. Thanks so much for watching. I hope this gave you a new framework for thinking about your investment decisions. Now, I want to hear from you. In the comments below, let me know which cognitive bias you've struggled with the most in your own investing journey. Sharing our experiences is a great way for all of us to learn. If you found this video helpful, please give it a thumbs up and consider subscribing for more content on smarter investing. See you in the next one.